Most of you watching this have already had a 1-0 bagger sitting in your portfolio at some point. Maybe it was a stock you bought on instinct, or a tip from someone you trusted, or just dumb luck in the right sector at the right time. And you either sold it too early because you got nervous, or you held it all the way back down because you got attached. Either way, you didn't keep the money. And the brutal truth is that finding the right stock was never actually your problem. Your problem was everything that happened after you found it. I'm going to give you 6 stocks today where that 10 times possibility is mathematically real inside the next 12 months. But if you walk away from this video with just the 6 names and none of the thinking behind them, you're going to repeat the same mistake you've already made. So stay with me, because the names are the easy part and everything else is what actually matters. If you're not subscribed to this channel yet, I'll be honest with you, that's a bad decision. Dressed up as a neutral one, the kind of institutional thinking I'm walking you through today costs serious money when you pay for it privately. Here it costs you nothing but a click, subscribe, turn on notifications, and don't miss what comes next. I promise you it's worth more than whatever you're doing instead. I've been doing this long enough to have watched a lot of smart people lose money on the right stocks. And that sentence should bother you, because it means the stock wasn't the problem. Let me show you what I mean. PayPal peaked at $310. It's trading around $40 today. That's not a bad company. PayPal processes billions of transactions. It has real revenue, real infrastructure, a real business, but $10,000 invested at the peak became $1,500 for the people who bought it when every financial magazine in the world was putting it on the cover. Plug power, the hydrogen revolution, genuinely interesting technology, peaked at $75 and is now trading at roughly $2. That is a 96% loss. BlackBerry, Neo, Lucid, pick your poison. Every one of those companies was real. Every one of those stories had genuine merit at some point. And millions of ordinary people lost a staggering amount of money holding them because they had been taught that patient. Long-term buy and hold investing was the intelligent approach. Here's what I actually think about buy and hold. It works beautifully for a very specific kind of investment and a very specific kind of environment. Broad, diversified index funds held for decades. That works. A handful of genuinely dominant, cash-generating businesses held through cycles. That works too. But using buy and hold logic on speculative growth stocks in fast-moving sectors, that's not a strategy. That's just hope with a respectable name attached to it. Wall Street doesn't operate that way, and they never have. The people managing institutional money don't fall in love with positions. When the data changes, they change their view. When the story shifts, they take profits and redeploy. The retail investor, meanwhile, is on Reddit defending their position, averaging down into a deteriorating thesis, and telling themselves that the stock market just doesn't understand the company yet. I've seen it hundreds of times, and it always ends the same way. You have to be willing to be wrong and act on being wrong, because the market will take your money with complete indifference to how convicted you are. Let me tell you what kind of market we are actually in right now, because this context changes everything about how you should be positioning yourself. And for the last couple of years, financial television has been using the phrase stock pickers. Market almost constantly, and every single time I hear it, I want someone to just explain what it actually means in plain language, because the phrase gets thrown around like everyone already understands it, and almost nobody does. Here's what it means. When the gap between the best performing stocks and the worst performing stocks in the market gets really, really wide, wider than it normally is, owning everything through an index fund starts to make less and less mathematical sense. Right now, 77% of the S&P 500's total gains for the entire year have come from just 12 stocks, 12 out of 500, which means if you own the index, you own those 12 winners. But you also own the other 488 stocks that are collectively dragging your performance toward mediocrity. You're carrying dead weight and paying for the privilege. Again, I'm not telling you to go sell your index. Funds today, they're still better than sitting in cash, which is what an alarming number of people are doing right now. But I want you to understand the mathematical reality of the environment, because it explains exactly why 6 carefully selected small cap names can do something that the broader market simply cannot. The small cap picture tells an even sharper version of the story. The Russell 2000, which tracks 2,000 smaller companies, has gone essentially nowhere as an index for 2 years running. Flat. But inside that flat number, there are individual small stocks that have gone up 100% in 3 months and others that are down 50% in the same window. The index number hides both the disaster and the opportunity underneath it, and it's that massive gap between winners and losers, that dispersion that creates the conditions where a stock can go up 10 times. Because when institutional money decides to move into a small, under-owned name with a real catalyst coming, there are not enough shares available for them to buy. Quietly, the price moves fast. That's not a bug in the system. That's the mechanism. And right now, we are watching institutional money begin to move into specific names and specific sectors before the mainstream retail audience has any idea it's happening. That's the window. It doesn't stay open for very long. 4 themes are driving where the serious money is flowing right now, and every stock on today's list sits inside at least one of them. I want to walk through each theme briefly because understanding the macro current underneath a stock is what tells you whether you're catching a genuine wave or just guessing. The first is hard assets, which is really just a sensible response to the reality that the United States government is going to keep spending money it doesn't have. Every dollar printed reduces the value of every dollar that already exists. And the investors who understand monetary history really understand it, not just intellectually, protect themselves by owning things that cannot be manufactured out of thin air. Physical commodities, real mines, assets that took decades to build and cannot be replicated by a competitor in any reasonable time frame. The specific opportunity right now is in commodity producers that have had a rough few years operationally and are trading well below their historical valuations at the precise moment when the macro environment is turning in their favor. The second theme is defense spending, and I'll just call it war spending because that's more honest. NATO is rearming at a pace we haven't seen in 40 years. AI integration into military infrastructure is no longer a future budget line. It is a present-day procurement priority for virtually every government in the Western Alliance. The interesting investments here are not the large defense contractors that everyone already owns and that will return 20 or 30% on a good year. They're the smaller, faster-moving companies building the AI analytics and intelligence tools that those governments are writing checks for right now, where a single contract announcement can move the stock by a third in a single session. The third is quantum computing. And I want to say something honest about this sector before we get into the specific names. A year ago, almost to the day, I put 3 quantum stocks on this channel. Rigetti went up over 1,000%. D-Wave went up around 800. IonQ tripled. And then the sector corrected violently. And the people who bought near the top got absolutely destroyed. I watched it happen. So when I come back to quantum today, I am not doing it from a place of excitement about a hot theme. I'm doing it because the underlying commercial reality of this technology has materially advanced since then. Governments are treating it as a strategic asset at the sovereign level, and the stocks have pulled back far enough that the risk-reward is interesting, again, in a way that it was not 12 months ago. The fourth theme is what I'd loosely call the mental health pharmaceutical revolution, which sounds dramatic until you look at the clinical data and the regulatory history. The last genuinely new class of psychiatric drugs was approved roughly 40 years ago. 40 years. The market for treatment-resistant depression and post-traumatic stress disorder is enormous and deeply underserved, and psilocybin-based therapies are now far enough through the clinical trial process that the FDA pathway is a real near-term consideration, not a distant theoretical possibility. Now let's go through the 6 stocks one by one, and I'm going to be straight with you about each of them, including the parts that worry me, because a list without honest risk assessment is just a sales pitch. Rigetti Computing is the most aggressive name on this list, and I want to say that clearly before I tell you why I find it interesting. Their cash position is thin. Revenue growth hasn't hit the kind of numbers that make a traditionally minded analyst comfortable. These are real concerns, and you should not brush past them. What Rigetti has that most of their competitors don't is full vertical integration. They own their own quantum chip fabrication facility, which means they control the manufacturing process rather than outsourcing it. So in a technology this new and this complex, the kind of control over your own production is enormously valuable. Their chips are currently the most accurate quantum processors available by published benchmarks. And they have a new chip called Lyra coming later this year that represents a genuine technical step forward. The catalyst calendar is real: a $100 million UK government contract, an $8 million India contract, a $250 million platform integration with NVIDIA, and the Lyra launch itself. Any one of those hits in the right way and the stock moves hard. But this one you size accordingly and you watch the cash position closely, because thin cash on an early stage tech company is how you get diluted into the ground. D-Wave Quantum is the name I find most intellectually interesting of the three quantum stocks, and probably the most misunderstood. Everyone else in quantum is building gate model computers designed to eventually solve a broad range of problems at some point in the future. D-Wave has spent 25 years building a machine designed to solve one specific category of problem: optimization. And that machine actually works commercially right now, not eventually. Finding the most efficient delivery route for a fleet of trucks, scheduling thousands of workers across complex shift patterns, optimizing a supply chain with 1 million moving variables. They have 135 paying customers, including LG, Sharp, and Anduril. Real businesses paying real money for a product that solves a real problem better than anything else available. Their gross margins are around 65%, despite the fact that they are manufacturing extraordinarily complex hardware. That number matters. It tells you that customers are not just tolerating D-Wave's product. They need it in a way that gives the company genuine pricing power. They also have 8 years of cash on hand, which means they are not operating with a gun to their head, the way some of the earlier stage names are. They have an investor day scheduled at the New York Stock Exchange in June. Companies don't do that when their numbers are heading in the wrong direction. Of the three quantum names here, this is probably the one I lose the least sleep over. IonQ is the revenue leader in the sector, and the numbers are hard to argue with. 428% year-over-year revenue growth, $62 million in a single quarter. They are guiding toward over $200 million in annual revenue this year, which would make them the first quantum company in history to cross that mark. The acquisition of Skywater Technology, a U.S. semiconductor foundry that holds one of the hardest to obtain defense manufacturing approvals in the country, transforms IonQ into a vertically integrated operation capable of building chips for classified defense programs. Right now, about 80% of their revenue comes from commercial customers. The entire government and defense revenue stream is still largely ahead of them, which means the current valuation doesn't fully price in what the business could look like in 2 to 3 years. They will keep losing money in the near term because they are investing heavily. And that is the right decision for a business in this position. The Palantir parallel is not a perfect analogy, but it rhymes. A company investing aggressively through losses to build a dominant position in a strategically important technology that governments and large enterprises will eventually need to own. When IonQ's losses start turning, watch the stock closely. Compass Pathways is the name where I will understand completely if you look at the numbers and decide it's not for you. There are no revenues. There are no margins. There is nothing on a financial statement that would give a traditional value investor any comfort whatsoever. What there is a compound called COMP360A, synthetic psilocybin therapy, that has completed phase 2 clinical trials for treatment-resistant depression and is currently in phase 2 trials for PTSD. The company IPO'd at $17 in 2020, ran to $60 on hype, crashed below $4 when reality set in, and has been sitting in that valley of disappointment that follows the initial hype cycle for every genuine one trials new technology. The history of innovation is full of things that were too early, then forgotten, then enormous. This is a binary situation. FDA approval produces an extraordinary upside because there is no existing competition in this drug class, and the addressable population is massive. A clinical setback produces a very painful loss. You need to know which of those outcomes you can live with before you put capital here. And you need to size it to reflect that this is a genuine speculation, not an investment. Compass Minerals is going to seem completely out of place on a list like this, and that's exactly why it's here. They mine salt, the kind that goes on roads in winter and into food processing, and a specialty fertilizer called sulfate of potash that goes onto premium crops. They have a salt mine in Ontario and a potash operation in Utah. These are physical assets that took decades to build and cannot be replicated quickly by anyone. AI is not disrupting salt. You cannot print potash. The company has had a genuinely tough couple of years. Some operational problems, a debt load that got uncomfortable, a stock that fell from $100 to around $30. But the debt restructuring is improving visibly. Fertilizer prices are rising sharply for reasons connected to ongoing global supply disruptions. And the market cap at roughly $1 billion looks quite small relative to the physical asset values sitting in the ground. I like this name partly because it has nothing to do with AI or technology, and in a portfolio that's already carrying speculative tech exposure, owning something with a century of physical reserves and rising commodity prices behind it is just sensible diversification. Big Bear AI is where I want you to pay close attention because the setup here is unusual. They provide AI analytics for defense, national security, border security, and supply chain intelligence. They get paid by two of the largest capital flows currently moving through the global economy simultaneously, AI infrastructure spending and defense spending. Their margins are not great today, and I'm not going to pretend otherwise, but their Department of Defense contracts are real and they tend to renew because switching costs in national security infrastructure are enormous. The market cap bounces between $1 and $3 billion. And it does that partly because the float is small, which means that when a contract announcement hits, there are not enough shares for everyone who wants to buy them. The price moves fast. The structural story here is remarkably similar to where Palantir was before it ran 600%, a small, under-owned AI defense company with sticky government contracts and a pipeline of new business driven by a macro tailwind. That is not going away. Palantir is now $50 billion and is not going to 10x from here. Big Bear AI is a fraction of that size with the same basic setup. That doesn't make it a certainty. It makes it a well-structured speculation. Let me give you the three things that have to be true simultaneously for any of these to actually produce a 10x. Because understanding the mechanism is what keeps you from making the same mistakes that killed people on the last quantum cycle. The first is size. I keep coming back to this because it is genuinely the non-negotiable mathematical constraint. Large companies do not increase 10x in 12 months. It has never happened. The physics of capital don't allow it. What does happen fairly regularly in the right environment is that a company worth $1 or $2 billion gets repriced to 10 or 20 billion when something material changes about its prospects. Every name on today's list sits in that 1 to 10 billion range, deliberately. That's not a coincidence. It's the only zone where math is even theoretically possible. The second is a specific near-term catalyst. A 10x return doesn't accumulate slowly over time. It happens in bursts, driven by concrete events that force the market to fundamentally reassess a company's value. FDA decisions, government contract announcements, earnings that show a business crossing from loss to profit for the first time, technology milestones that prove a product actually works at commercial scale. Every stock on this list has at least one of those events on the calendar in the next 12 months. That's not something I arranged. It's a filter. If a stock doesn't have a specific time-bound catalyst, it doesn't belong on a list like this, regardless of how good the long-term story sounds, because without a catalyst, the market can ignore a good story for years. The third is position sizing, and this is honestly where most people fail more completely than anywhere else. Speculation is not stupid. Badly sized speculation is stupid, and the difference is everything. Each of these names should represent somewhere between 1 and 3% of your total investable assets. Not because I don't believe in them, I do, or they wouldn't be on this list, but because each of them could also go to zero. And that is a real possibility that needs to be built into your thinking before you put money in, not after. If 1% of your portfolio goes to zero, you had a bad day. If that same 1% turns into 10% of your portfolio because the stock went up 10 times, you've had a year. That changes things. That asymmetry where the loss is survivable but the gain is meaningful is the entire logic of intelligent speculation. What wrecks retail investors is not picking bad stocks, it's picking decent stocks and sizing them so aggressively that a single bad day creates a loss they can't emotionally process. So they sell at the worst possible moment and miss everything that comes after. I'll leave you with this. I've sat in enough markets and been wrong enough times to know that no list of stocks is a guarantee of anything. The 6 names I've given you today are the result of a real filter, small enough to move, real enough to survive, with genuine catalysts on the near-term horizon and institutional money already starting to build positions. That combination doesn't show up often. And right now it's showing up in these 6 names across 4 very different sectors. What you do with that information is entirely your decision. But I'd ask you to at least apply the 3 rules before you do anything. Check the size, confirm the catalyst, and make sure your position sizing reflects the actual risk you're taking on. The investors who got hurt on the last quantum run weren't stupid people. They just didn't have a framework for managing the position once they were in it. You now have that framework. Whether you use it is up to you.